up, guys? My name is Amy. Welcome back to my channel. Today we're going to be talking about investing and an intro to investing for beginners. And so on my channel I talk about fitness, health, wellness, but also some financial tips for anyone who's working on building their wealth. Investing can be super daunting. Most of us don't know how to invest. Most of us weren't taught when we were younger, and that's why I want to share with you guys. The reason why I'm starting with these videos is because I want to share with my younger brother on how to start investing. So we're going to start with the basics today. We're going to start by learning what is the stock market, what is a stock, what is a bond, what are mutual funds, and the last one, what are index funds. So the first thing we're going to be talking about is the stock market. What is the stock market? And so the stock market is essentially a place where people buy and sell stocks, where they trade stocks. And you can think of this as any other market. We have markets such as the car market. You're buying and selling cars. All right, number two. So what is a stock? So a stock is essentially a share of a company. And so when you buy a stock, you're essentially buying a share of the company, and you now own a part of it. And so for an example, a stock that I bought recently was Southwest. And so I now own a share of Southwest, but there are millions of shares in Southwest, and so you just own a really small fraction of the company. Now, the reason why companies offer stocks is because they want people to invest in their company. That way they can continue building. And for you, you want to invest because eventually you're hoping to gain some sort of return, whether that's a dividend, when the company continues to grow. So another example of a stock that you can buy would be like Google, Facebook, Tesla. And the reason why people purchase these stocks is because they believe in the company. They believe that in 10 years the company will continue to grow, and that eventually that they'll get returns, whether that's through dividends or whether that's just from the perceived growth or the value of the company itself. So that's why people purchase stocks. All right, guys, so number three, what we're going to talk about are bonds. So bonds are essentially loans to governments, to companies, or any entity, and that's different from a stock because the money that you're putting in is a loan. Essentially, you're letting them borrow money from you that they're going to return, whether that be in 10 years or 30 years, and the money that you gain from a bond is through an interest. And so there are four types of bonds that we're going to talk about. The first one is a treasury bond. And a treasury bond is essentially a loan to the government, to the federal government. The second one is a municipal bond. And a municipal bond is essentially a loan to a city, a state, or a county. The third bond is a corporate bond, and essentially what that is a loan to a company. And the fourth and final bond is a high yield or junk bond, and those bonds tend to be bonds for smaller companies, those that have less credit and therefore have higher interest rates. Now, should you buy a stock or a bond? And that's really dependent on multiple factors, the first being whether or not the interest rates are high. So if the interest rates are super high right now, you should go into bonds because over time the interest is going to compound and you'll be making more money from the bond. However, what you have to do is compare that interest rate from the bond to what you think you'll gain from a stock by purchasing the stock over time and what the return will be. Another reason to check out bonds are because they tend to be a little safer, less risky, and that's because the company is borrowing money from you. And so legally, they have to pay the money back unless they default. All right, guys, so the fourth definition we're going to go over is a mutual fund. And so a mutual fund is essentially a basket of stocks that you can purchase in which you can own shares of different stocks. For an example, you can own Microsoft, Google, Facebook, all in one product. So you're purchasing one product, and now you own shares of each stock or a percentage of each stock. And that allows for diversification. However, with mutual funds, they're actively managed by professionals. And because of that, you'll be charged high fees, typically 1% to 2% a year, and that can really eat away at your investments as well as any profits that you're planning to make. All right, guys, so last but not least, we're going to talk about index funds. And so index funds are essentially a type of mutual fund that's passively managed, meaning you don't have someone professionally managing your portfolio. You are still able to purchase this basket of stocks, and what an index fund does is it tracks an index. And so an example would be the S&P 500, an index that has the top 500 companies and how they're performing right now in the stock market. When you decide to purchase an index fund that follows the S&P 500, you're essentially purchasing small shares of all of the companies that are in the S&P 500. So you don't have to hand select the stocks, and that's why a lot of people have decided to go with index funds, because you don't have to select one stock. You don't have to go all in on one stock or one company. You can have a diverse portfolio of different companies and different stocks and bonds, and it's not actively managed, and so you're not paying high fees for someone to manage your portfolio. Alright guys, so those are the 5 definitions that we went over today. I hope they were helpful. They've helped me come a long way. It's really important to start from the foundation up and understand these definitions first before you dive into the stock market. Alright guys, I'll catch you guys in my next video. I hope you guys have a great day.